Good morning, ladies and gentlemen, and happy President's Day holiday. The risk dial keeps on being in the yellow to green area, i.e., it still prefers equities to bonds. I would like to do something slightly different for this holiday and basically give you some of my longer term thoughts and examine the environment that we are in and why I think ranges are going to be smaller for the next few weeks until we decide which of the scenarios that we are in is the most likely. Last week I showed you this slide with the three possibilities of a hard landing, a soft landing, and a no landing. And I think that this is what we are going to be battling for a long time. This can only be resolved by data, and not only data that the market agrees with, but that the Fed agrees with. I think that this week was pretty indicative of what we're going to get. I don't think the odds are high that we will get data which all agrees with itself, i.e., we had a CPI which was not hugely out of line, but the market was badly positioned for it because everybody assumed that we would get a continuation of lower CPI surprises, and we didn't. And then we had a slightly higher PPI surprise. So the battle between these three scenarios is going to be prolonged, and simply because the data is not all going to agree with each other, and therefore we will be crabbing along, i.e., basically 2 steps forward, one step back. While that lasts, ranges are going to be smaller. And of course, the only thing that is going to decide everything eventually is yields and the yield curve. And at the moment, as I'm now going to show you, that is very, very unlikely to happen anytime soon, and it's very indecisive. This indecision is reflected in the fact that we just can't move away from 2.2% in the five-year forward inflation expectation rate. We are just going 10 basis points above, 10 basis points below. For the market to be happy and content that the inflation battle has been won by the Fed, we need to start going decisively below 2%. And I don't think that that is likely to happen in the immediate future. In fact, if anything, the 10-year break-even inflation expectations are rising. This dichotomy has to be resolved. We need to get everything below 2% because the market, it always tends to be too optimistic or too pessimistic. And for us to be able to declare, or for the Fed to be happy to agree with the market that the inflation battle has been won, I think we need to see all these indicators, these fundamental indicators, below 2%. While that does not happen, we just cannot move significantly from the levels that we are at the moment. So basically what happened in 2022, we realized that things were far out of balance, and we have gone to a new level where we think things are more or less in balance. To be able to say that they are no longer in balance and we need to go to new levels, we need much more new data. Not a single piece that is then contradicted by something else, but we need continuous data all pointing in one direction. I think that that is very unlikely to happen in the short term. And while this indecision in the data persists, the indecision in the market has to persist as well. I keep on telling you about the negative carry. The negative carry means that dealers will only jump on bonds when they have a pretty damn secure and certain gain of a few basis points that they can make very quickly, because nobody wants to carry positions for weeks on end. Because, you know, that the longer you carry them with negative carry, the more money you need to make just to break even. And therefore, while 3 months is still in an uptrend and going, you know, with a terminal rate of unknown, which could be anywhere in the fives, you are not going to see sustained gains in the twos, fives, and tens, or even the 30s, simply because, you know, dealers will not facilitate it. If we go to the 2-year, you get this kind of behavior, which is not breaking out, because none of the data yet says that we need to break out and be permanently for 2 years at 5%. But you get this, you know, it gets slightly worse and then slightly better. I would have thought that any time it gets down to this 442 area, there's going to be a whole load of people who will want to get out of any longs that in futures that they've positioned up here, and they no longer see the benefit of being long or sustaining the negative carry, and therefore they're out, and therefore the market goes back up towards 475. Same thing in the fives. I think it's very clear that anything in this kind of area between 390 and 382, people are just not going to be willing to carry the positions. Do they see any possibility that we go down very quickly to 360 without data? No, they don't. Why would they? You know, could we get that kind of a move down here on PCE? Yes, but it's not going to be sustained. And therefore, I think slowly, you will get this crabbing. You will get, you know, one piece of data which is good, you get, you know, 10, 15 basis points up, and down in yield. And then over time, you get the bleed. And that's going to continue the shorter the contract. So it's going to be in twos and fives and less in tens and 30s, but also in tens and 30s. I would have thought that if tens go to this area between 369 and 362, you will have a whole load of people who want to basically get out and bet that it's going to go back towards 4%. With the carry. So that is basically the kind of environment I think you're in. You are looking for an extreme in the low fours and another extreme somewhere near 350. And that is your range for the foreseeable future until all the data agrees with each other. And I don't think that that is going to be for a very long time. The yield curve is telling you much the same thing. These are the twos, tens, and you can see how it just keeps on inverting more and more. But when it reaches this round 90 level, gravity takes over, because the negative carry on the tens is so much greater than the negative carry on the twos. And unless there's a very, very good reason to keep it up here, it comes back. So over the course of a week, it just does nothing very much. And this has to continue until the twos are ready to come back and start smashing through the zero level. And that is only going to happen once you have an imminent sign of recession. Are we having that? No. Are we likely to have that in the next couple of weeks? No. So what the yield curve is telling you, and you know the 530s are telling you much the same kind of thing. Where are the 530s? Here they are. You know, you get you get the because the difference in the negative carry between the fives and the 30s isn't that huge. Every time you get bad data, i.e., data that the bond market doesn't like, the fives 30s take more of the pressure, but still they can't sustain very negative levels because people just don't want the negative carry, and then you get a couple of days of bleed. But the overall direction is one of at zero. For this to remain below zero for any length of time, you need the almost the certainty that the yield curve is going to go back to flat. And at the moment, we just don't have that, which means that the natural direction for this is to go higher, but not much higher. I.e., every time you can pick up, the market will decide to pick up. If there's a pickup to be had between fives and 30s, the market will do it. Simply because, A, the market always needs duration, but B, also it's a bet. Buying fives 30s on a positive pickup is a bet that there will be a continuation of uncertainty. And that, at the moment, is a good bet. Much the same is true for Germany. It's a very boring chart. This is the Schatz. It'll just, spend a few days sideways and then it'll go higher. I really don't think that there is a target that Schatz hasn't met that is logical. And to me, the logical target at some stage over the course of the next couple of months is 341. I think that is much more likely than not to be met, and basically the Schatz will continue to bleed. To me, that is probably the most obvious trade, and as is, I could show you all these, but this is boring, and you can look at it yourselves. But really, the one that to me is the most likely is the continuation of the negativity of the yield curve to at least -60, -70. I very much, this is 2s10s, it basically the same kind of yield curve shape as in the US. This will, there is absolutely no reason to think that the curve in Germany does not get more inverted, and that the ECB keeps on tightening even more than the market expects. Unless you see, 3 months or 1 year turnover, at least the 1 year, and 3 months just keeps on going up, keeps on going up, keeps on going up, it'll get into the 3 to 3.5 area. So there's absolutely no hope for the Schatz in the short term. In terms of yield differentials, Germany, US, nothing has changed. I think it's going to be this is Schatz 2s. I think 193 is your level. You get anywhere close to that, you shut your eyes and you sell Schatz against the 2s. Bobble against the 5s. I think, nothing has changed here. Anything around 170, you're a seller. 10s, anything around 150, you're a seller. I think it's really as simple as that. And that indicates to me that everything I've been saying about where yields are going in on an outright basis in Germany and in the US is absolutely right. You're going to be battling for 5, 6, 7 basis points if you can make them. Volatility is going to remain low. This chart of move basically tells you everything that there is to know. The whole of last year, really, we couldn't trade below this 110 level, right? and now we can't trade above it. So that to me indicates a period of trading between 100 and and 115, basically staying around here, which tells me that there will be no big moves in the yields. Okay, one piece of data might come out which is very frightening, in which case, yeah, we're going to have a pop. But what kind of data can that be? It can't be an unemployment piece of data, because we know the employment situation is strong. Could it be PCE? Yes, it could be. It could be a much stronger PCE number than the market expects. But is that likely to be sustained? I don't think so, because we are very likely to get another piece of data which contradicts it very, very quickly. So, yeah, it's possible, and I wouldn't bet the farm on any one number, but I would be much more reluctant to sell a dip than sell a rally in futures, in the bonds. I think rallies are there to be sold, because the situation will not be resolved for a long time. If the market had made up its mind that rates were going to scream higher, because inflation in the States is higher than the Fed expected, and the Fed needs a new terminal rate, etc., 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 i.e., if we had resolution, I think DXY would scream higher. So what was the difference net between on the week? 103.60 to 103.86. Okay, so what's that? Point one and a half, i.e., we went nowhere, which to me says that we have no resolution, and we're likely to have no resolution. I think we are far more likely to trade in much smaller ranges, and I'm quite convinced that the risk reward at this 106.25 area, with the 200-day moving average coming in at 106.45, is extremely bad. What would that indicate? If the risk reward here is bad, that means that the differentials are unlikely to go very much below the levels that I showed you on the 10s or the 2s, but also that they're much less likely to go above. So to me, you're going to get a period of relative stability in the dollar, as well as the differentials, and as well as the absolute level of rates, i.e. the change in the absolute level of rates, or the rate of change of them, is going to be smaller. The move index is going to remain contained, because we're not trading 20 basis point ranges per day anymore, but we're trading 4, 5, 6 basis point ranges. And if that happens, that dampens the volatility in the dollar as well. I think that fits together, right? Gold is very much saying the same thing, and that's why I like the scenario that I've just presented you, that we're fighting for a few basis points in the bonds. It traded at 1830, bounce. To me now it looks like it's going to trade 1881 again, maybe slightly higher. Basically touch the middle of these Bollingers around 1900, 1881. To me, that is all you're going to get. It's basically in a range between 1959 and 1830 at the moment. If you see a dip down to 1764, that I think is going to be a very, very good risk reward level to get long gold again. The way I'm playing it is basically, I sold it up there, I bought back down here, I might re-short up here, depends how I feel, but not as much as I sold up here because the risk reward isn't as good. But that is all you're going to get. I don't think you're going to get big moves in gold because I don't think you're going to get big moves in the bonds, and therefore I don't see or the dollar, and therefore I don't see what is going to make us have very large moves in gold. I think it's not a positioning market. Again, I think it's a trading market, and probably, most probably, 1830 to just slightly higher than 1881 for a while, which is a lower period of volatility. It's just, unless the TLT breaks the year's lows, I doubt very much that gold can go much lower than 1830 because those are its year's lows, right? We're right here. Unlikely for the time being. While oil is doing this kind of thing on the monthlies, i.e., hanging on to 75 by a fingernail, and while the dailies are below a downward sloping 200-day moving average, and while, I keep on reading how oil is going to scream to 120 and 140 all over Twitter, I just can't get bullish of oil. I think people need to give up on oil for it to start getting bullish. And if the biggest component of the commodity indices is doing this, then it's hardly surprising that DBC is doing that, i.e. it's basically just hanging on to the lows of the year. And, certain moving averages on the weeklies are turning, indicating that we are very much unlikely to break higher in the immediate future. The gold against DBC is slowly turning, which doesn't mean it goes a lot higher. It just means that it's turning. It's just giving you the probabilities are slowly changing. And if the probability that DBC is going to go higher is diminishing, I really don't see why we're going to get a significant breakout in bonds. Certainly not a parallel shift in the curve where the Fed needs to tighten to dampen down, sort of big inflationary expectations. I think it's far more likely that at the moment we continue sideways, that those are the odds. And if the odds are that we continue sideways, that means that the bonds are more likely to continue sideways. And if the bonds are more likely to continue sideways, so is the dollar. And if the dollar is more likely, then it's gold. And then finally, it's equities. So if we are content to play a range in bonds and a range in gold and a range in the dollar and a range in commodities, why would we deviate that much from an 18 times Blue Angel? You can see that the expectations of earnings keep on being on a downtrend. I would argue that probably times 18 is a little bit rich given the yield level of the 30s, but 17 is what, somewhere in the 3900s, right? I mean, low 3900s. Why would we be surprised if the market just trades 2-3% below and 2-3% above this times 18 line for a considerable period of time? I just don't see any reason why we would be surprised. So what would that be? That would be, let's call it 3,900 to 4,200, right? And why would that be surprising? Why would be what is that, just less than 10%? Let's call it 7.5% between friends range for 2, 3, 4 months. Why would that be surprising? I don't see any reason to be surprised by it, and in fact, that is what VIX is saying. And here you have VIX, right? So this is where we closed the week last week, and this is where we closed this week, down like a gnat's ass. So, and where did equities close? The S&P closed within a couple of ticks of where it closed the week before. The Nasdaq did much the same. The Dow did much the same. I mean, the differences in the weekly close. Let's have a look. I mean, let's go to ES and let's have a look at the week. Right, so where did we close last week? We closed 40.90, and where do we close this week? 40.80. Okay, so that's that. YM, let's have a look at YM. Where's my YM weekly? What do we close? I think is that like 10 ticks different in it's like nothing. We just keep on closing at the same level. We keep on trying to break higher, it can't. We can't keep on trying to break lower, it can't. And we keep on closing unchanged. NQ, you know, where did we close on NQ? Very much unchanged to where we closed before. So I really don't see that anything here is telling me that my analysis or what the bonds are doing is wrong, because let's face it, the bonds are more or less driving this. You know, I think NQ, if you see 11,850, it's a very good buy. And it's, if it were a sell, the market would not be respecting these Bollinger Bands so well. Okay, when you have impulsive moves, the market breaks about below the Bollingers like here and stays below the Bollingers, and it's time. It basically just goes sideways and then down again. To me, when it bounces like this, like it's done, let's try and enlarge it here. That is a sign of a trendless market. They might try the downside again, but it'll bounce. It's all saying the same to me. Do not sell the whole seller rally. Don't don't buy a shallow dip. Buy a deeper dip. That's all there is. That's all there is to it. These markets are sideways markets that I have not decided where they want to go, because they can't decide on which of those three scenarios is winning out. All it's happening is that the probabilities are shifting, and the market goes up and down with the shift in those probabilities. But until all the data agrees with each other, you're not going to get a sequential increase in the probabilities, and therefore a trend. As a last piece of evidence, I want to go through some risk indicators to show that they are just not in risk off. And if they're not in risk off, the odds of equities going down a lot are low. So this is SPY over TLT. I think that unless we start breaking this line, we're not going to be in risk off. We're going to be in trading mode. Up, down, i.e., sort of bonds do slightly better, equities do slightly worse. But those are 2-3% moves that we're talking about in equities. To me, RCD over RHS is actually probably going to be the best indicator longer term. Until we start breaking below here, I don't think we can say that we're going to be in risk off. It's just a trading, could this do an ABC and could it fill some gaps? Yes. And yeah, okay, so the SPX goes slightly below 4,000. Everybody gets really bearish, boom, straight back up. What I'm trying to say is that nothing that I look at is in a bearish trend. None of the indicators of risk are bearish. Some of them might be overbought, and some might say that some will come down slightly. But that is not a trend. To me, we're far more likely to stay in a tightish range in equities against everything else rather than not. I've updated all the levels. The one I think that's going to be most interesting is if you get a bad PCE or you get a mention of something to do with an extension or even a stronger QT or discussions of more QT or selling of mortgages by the Fed in the Fed minutes. Those would be interesting, and those would put the cat among the pigeon. And I'm trying to figure out what the implications would be, but they wouldn't be good. The first reaction would be very bearish in both bonds and equities. But I think this 13,984 level in SPX is going to be very, very interesting. And I'd certainly buy some calls there. Simply because I don't think that any bearish reaction is going to be sustained. And therefore, I'm a buyer. I'm a buyer at that level, and we'll see what happens. But I think gold sideways, and basically that is where we are. Bond sideways, gold sideways, dollar sideways means that any weakness in equities, I'm a buyer of. Thank you very much indeed. Have a wonderful long weekend, and tweet you on Tuesday, if not on Monday.